US Federal Reserve's sort of fasten the pace of tapering in terms of that asset purchase and possibly use interest rate hikes as a measure to bulwark that inflation that is starting to seem out of control. So from our end, what we actually anticipate is that that monthly asset purchase program will be tapered at a faster rate and possibly phased out before the end of the first half of 2022, which was the initial agreements that the Federal Reserve's reached. And also, we think that there is the possibility, or it is very likely that we see the US Federal Reserves start to normalize interest rates as early as the first half, or let's say as early as the second quarter of the year 2022, as a measure to tame inflation and prevent that reoccurrence of that 1970s type runaway inflationary trend. So I think next I would be moving on to, I would say, a very interesting relationship, which would, to a very significant extent, sets the premise for a lot of things that we would be discussing today with regards to that sub-Saharan Eurobond market performance and our expectations. And that is the relationship between the US 10-year Treasury and those SSA Eurobond papers. So what we've done here is we've taken a look at that relationship over a 5-year period. And within that time frame, what can be seen is that for a large part of it, that correlation wasn't quite strong. We didn't see them, move in tangent with each other. And what that would imply is that for those SSA papers, the determining factor for their performance was largely those country-specific factors and also those commodity performance. That's the commodity that each of those nations relied upon. So for the likes of Nigeria, if you had to look at the SSA performance, you will see that it's quite in tangent with what is happening with regards to crude oil. I think that same narrative holds sway for the likes of Angola, while for the likes of Ghana, you would see that there's that strong deal of correlation between that Eurobond movement and what is happening with regards to cocoa. But what we will now observe is going further down the line within that time frame, particularly between 2020 and now, that correlation between the 10-year Treasury and SSA papers started to become more material. They started to be that direct relationship. They started to move in hand. So I think it's safe to say that over the last year, the movement in the SSA papers have now become that determining factor behind the performance of that say SSA Eurobond yield. So the 10-year Treasury pretty much is the determining factor of the performance of SSA papers, at least in the interim. And it's very likely we see that relationship hold sway in the next couple of months. So I think next I would move on to the performance in two of those key global areas. The first of which is the international oil market, and the second is the US Treasury. And these are two particularly important data points. I think I spoke broadly to why the US Treasury is quite important to look at, given that over the last year, it's been the key determining factor behind the performance of the SSA Eurobond market. And for the oil market, I think it's quite apparent Nigeria is still heavily dependent on this sector, and you can look at this from various perspectives. If you look at it from the perspective of the foreign earnings, you would see that we still depend heavily on crude oil, with black gold accounting for, say roughly 90% of our foreign earnings over the last, say, half decade. If you look at it from the perspective of the banking sector credit, you will see that somewhere around 30% over that same time frame. And if you look at it in terms of that government revenue, you'd see that we're still leaning heavily on the oil market, with that space accounting for roughly 70% of revenues that accrue to government. So I would kick things off by looking at the performance of the US 10-year Treasury over the course of the year. So at the start of the year, one thing we noticed is that there was sort of a northward push to that 10-year Treasury yield. And the reason for that is because of those inflationary concerns in the United States. So when we started off the year, we saw the US inflation sort of staying below their long-term target estimate of 2%. But as we approached, or as we got into March 2021, we saw inflation jump sharply above that 2% target to as high as 2.6%. And ever since, it's pretty been a journey northwards. So what we saw at that start of the year has been a corresponding, say, reaction in the US 10-year Treasury. We saw it soar as high as 1.75 as at the 31st of March, which is one of the highest levels we've seen it hit in, say, roughly a year and a half. So that was quite a very drastic movement, because when you compare that first quarter rate uptick to what we saw at the end of the year, you would see that it translates to an 84% upsurge over just the first 3 months of the year. And moving further into, say, that second quarter period, what happened then is that the Federal Reserve became more proactive in pushing out the narrative that those inflationary fears in the market might be quite exaggerated, given that the nature of the inflation that the US was experiencing and is experiencing is more transitory than that lasting type. So they use those or that narrative of a transitory inflationary trend to sort of assuage market concerns. So the consequence of that was that reversal in that strong uptick in the US 10-year Treasury, bringing it down back below that 1.5% levels. But then, of course, that retracement was quite short-lived, given that inflation, like the US Feds claimed, failed to be transitory, and most of those factors started to look like they would actually last for a longer period than the Federal Reserve initially anticipated. So as a consequence of that, of course, the market started to expect that some of those pandemic-related support programs will be rolled back. Particularly, they started to expect or anticipate that the Fed will start to reduce the size of its quantitative easing program. And that anticipation sort of started nudging yields back northwards. In fact, pushing it as high as about 1.7% late into October 2021. But then after the Fed actually, came to terms of what is happening and decided to put in place a very modest asset purchase tapering plan of $15 billion monthly, the market pretty much digested this news and realized that the Fed is not as hawkish as they would expect with regards to inflation. So we saw that uptrend moderate afterwards. But then, speaking to what we've seen, say, in the last couple of days, one key thing that has weighed on the performance of the US Treasury, or let me say one new variable that is now in that basket of consideration, has been the new Omicron variant of COVID-19. So what has happened is, as a consequence of those jitters around, say, a new virus that might prove to be more deadly, prove to be more contagious, we are starting to see a flight to safety across the world. And like I noted earlier, the US 10-year Treasury is actually a safe haven asset. So there has been some sort of interest around that. So we've seen the Treasury yield actually turn down southwards over the last couple of days, falling as low as 1.45 before rebounding or climbing back up slightly. So I think that is our take on the performance of the US 10-year Treasury over the course of the year. And going forward, the determining factors for how that space will perform would be one, of course, inflationary concerns and how that weighs on the decisions of the Federal Reserves with regards to, taking a more hawkish approach in order to, stay proactive and keep prices in check. And the second factor we would want to keep in view is actually that Omicron situation. And I think that would pretty much shape what happens going forward. So next, for the international oil market, for that space, I think it would be prudent to say that it's been quite a bullish year for oil prices, particularly when you use Brent as that benchmark crude. On a year-to-date basis, you see that Brent has done roughly, say, 36.24%. But then I think this performance isn't even as pronounced as it was, say, a week ago or 2 weeks ago, before Omicron, came into that space and became a topic of conversation. Before then, we saw oil prices, hovering at around the 3-year high, doing something north of 50% in terms of its year-to-date return. But then, not getting ahead of ourselves, just sticking to the present. Like I said earlier, it's been, quite a bullish year for crude oil, and we see oil prices, currently around that $70.57 per barrel, reflecting again that it's slightly north of 36%. But dovetailing into what has happened in the market and why we've seen that sort of performance, starting the year, some of the key drivers that really gave strength to the market bulls was, of course, that sharp rebound that we saw in terms of oil demand as several nations started to, sort of lower and ease up some of those COVID-related restrictions that have shortened that demand for oil in the previous year. So we saw some of those restrictions easing, and as a consequence, we saw that sharp rebound in oil demand, which gave support to that uptrend. And one of the other key factors that we saw that actually provided support to oil prices at that start of the year is that deliberate action by the OPEC plus bloc to actually restrict supply and to provide support to the markets. If you remember back in the year, back at the start of the year, we even saw the likes of Saudi Arabia take on additional voluntary cuts of roughly 1 million barrels per day in order to continue providing the much needed support for the oil markets. So that has been some of the contributing factor to that bullish momentum we saw in the oil markets. But when you move into that latter part of the year, there were other factors that sort of gave strength to that bullish narrative. The first was that impact of Hurricane Ida on the oil plants of the United States. It pretty much put some of those oil plants down, and as a consequence, subsumed or depressed the activities and the production levels of the shale producers, keeping them sort of way behind that pre-pandemic production level. Then another key factor that provided some sort of support to the oil markets is what we saw with regards to that global gas shortage that consequently impacted the entire energy space and created a bit of an energy crunch within that period. So those factors sort of came together to lend support to that bullish oil market, of course, against the backdrop of a fast-growing demand amidst a limited supply. But moving ahead to what we've seen within this recent periods, I'm sure a lot of us are conversant with this. It's, of course, still the impact of COVID, particularly the announcements of the new COVID strain of concern, which is the Omicron strain, and the consequences that's had in terms of that, I would say, knee-jerk effect on oil prices. So basically, what has happened is the realization that there could be a more disturbing strain has sent a bit of, I would say, a distasteful nostalgia of what we saw in 2020. And countries are not making it better, with a lot of countries swiftly implementing restrictive measures to ban the entry of individuals from countries that they believe might actually pose a significant threat in terms of transmitting that virus. So that narrative has been, quite reflective on the performance of oil prices, at least over the past week. As at last Friday, we saw oil prices nosedive significantly, coming from above $80 per barrel to somewhere close to $70, which is one of the most dramatic declines we've seen since somewhere around April 2020, when the pandemic had taken full effect and people were cognizant of the material risk it posed. So I think that has pretty much been how oil prices has fared so far this year. And I think what I would just do now is, I think a summary of what we've discussed on this slide is, of course, we've seen the 10-year Treasury rise significantly over the course of the year due to inflationary concerns, while the international oil market has been quite bullish due to, say, the multiplicity of bullish drivers that we have discussed earlier in this presentation. So I would just hand the presentation over to my colleague Uduak, so as to give a deep dive on what that performance has been in the sub-Saharan Eurobond markets, and also share our views on some of the expectations that we are looking forward to in the coming year. Over to you, Uduak.
Thank you, Afolabi. So I'll be taking us through the performance of the Eurobond market with a focus on select African countries within our coverage. So currently, our coverage is on Nigeria, Egypt, Ghana, and Angola. And this is mainly because these countries offer very liquid securities at attractive yields. So speaking to the performance of the Eurobond market in 2021, we saw the year start with the Eurobond market sustaining the positive wave seen in the prior year. And this was mainly spurred by the rising crude oil prices, coupled with various global stimulus being implemented to boost economic recovery. We also saw that the efficacy at which COVID-19 vaccines were being administered in developed countries had contributed to the bullish run in the market. So still in Q1, as my colleague Afolabi had already explained, we saw an uptick in the US 10-year Treasury yields, and given the recent correlation between these US 10-year Treasury yields and the emerging market papers, we saw this affect the sentiments in the Eurobond space as the sentiments turned sour. Basically, the Treasury yields were rising on the back of the inflation in the US. So the weak sentiment in the market was even further exacerbated by the US bond tapering concerns, and market completely ignored the positive trajectory of crude oil prices. In Q3, what we saw was the market being flooded with a high volume of issuances, and this was a derailment from the trend seen in previous years. So to put this in context, for the whole of H1, we saw about 6 billion being issued, and in September alone, in Q3, we saw an entire volume of 7 billion being issued. And the influx of issuances wasn't a surprise because the COVID-19 pandemic had hindered a lot of countries from coming to the market in 2020. However, this increase in supply affected the market negatively, and coupled with the existing US inflation concerns, we even saw a bit of reaction to the contagion effect of the China's Evergrande debt issue that came up. But that just lasted for a short period of time. However, all these factors altogether weakened the market between Q3 and early Q4. So currently, like Afolabi had also spoken to, what is happening in the market right now is, renewed COVID-19 concerns, particularly because of the emergence of the new strain, which is also driving a risk of sentiment in the emerging markets Eurobond space. So I have a couple of graphs on my right showing the average yield movement for the countries that we cover. If you look at some of the securities, in fact, all the securities, you would see that the yield levels in November 2021 are quite elevated compared to the average yield level in December 2020 and pre-COVID era. So you could also see that the yield levels in December 2020 was kind of aligning to the pre-COVID levels. And now in November 2021, the average yield level is quite elevated, which speaks to the dampened sentiment in the Eurobond, in the emerging Eurobond market space currently, and also to the opportunity there. So the graph at the bottom left shows the issuance trend in the emerging Eurobond market space for the past 3 years, and how the trend was usually like around 5 billion or so, but given the abnormality we saw this year, we expect to see that the levels will retrace back to within 5 to 6 billion. That's for next year. And the reason why we think this is because most of these African countries would want to keep their debt at sustainable levels so that their cost of debt doesn't go up, and they're able to control their already high debt to GDP ratios, as this is currently a concern, given that most of them have a debt to GDP ratio that is above 60%. And also some countries have also come to the market to speak on what their issuance will be like next year. We have Ghana, which is typically an aggressive issuer, indicating that it's only going to raise about 1 billion in 2022. And we also have Angola speaking to issuing about 3 billion in 2022. So moving on to the next slide. I'm going to be talking about the performance of some of these commodities that typically influence the emerging market Eurobond space. And the reason why this is because most of the countries under our coverage depend on export proceeds from these commodities to grow their external reserves. So looking at the UN Food and Agriculture World Price Index, we saw that the index was up for throughout the year, actually from the beginning of the year to October, even touching a 10-year high in October this year. And this was mainly because of economies opening back up during the year. This led to a surge in demand, which was met with a corresponding surge in supply, as most economies are going through global supply chain disruption. And this is basically what prompted the elevation of prices of these commodities from the start of the year to the end of October. And Afolabi has also shed some light on what happened in the crude oil space, speaking to OPEC holding back on supply, and even the demand surging higher than supply, and this also giving some positive trajectory to crude oil prices basically. So for next year we expect that after reaching this all-time highs, we expect some of these commodity prices to moderate and stabilize in 2022, as we would also expect that demand growth will slow and some of these supply constraints will ease. For crude oil prices, we see it averaging about $74 per barrel in 2022, which is up from a projected $70 per barrel in 2021. And this is largely because, the demand still significantly outpaces supply, and we're still going to have OPEC lending support in terms of restricting the supply. However, the caveat to this would be, the intensified COVID concerns in the horizon, given that we're still watching as to what scale the Omicron strain is going to, escalate to, and this could possibly reverse the uptrend that we're seeing in oil, and the risk of the strain could obviously become more material with time if it's exaggerated. So this will be all for this part of the presentation. I'm going to hand over to my colleague Emmanuel, who is going to dive deep into the macros of these select African countries under our coverage.
Okay, thank you very much, Woodwork. So would be given a country breakdown, and Afolabi gave us a global breakdown on the variables that has affected the Eurobond market this year, and also the outlook for next year as well. Woodwork has given us commodity specifics for each of those countries, and also the outlook for next year as well. So just giving us a deep dive into country specific of the Eurobond that we cover, Eurobond and African bonds that we cover. I think one interesting thing to note is that despite these headwinds that the Eurobond market is currently facing, normalization in global central banks, currently seeing some tapering there as well. All that has created is pretty much opportunities for huge gains in Eurobond markets. You can see that happened in 2016 when we saw the commodity price crisis there, led to an upsurge in yield, and also normalized thereafter. We saw that in COVID era as well. A lot of people made really decent money on the back of that uptick in yield. And we are seeing the same trend play out in 2022. So the team for 2022 will be pretty much the entry point that this normalization in global central bank and that is definitely going to create for those country specific. But nevertheless, you still have to look at the country specific to determine when exactly is the best time to enter. So just looking at Nigeria on the macro perspective, looking at the GDP growth, we've seen that we've pretty much recovered from last year's recession, comparing this 4.03 to where we were last year as well. Definitely a significant improvement there. In terms of inflation, we're seeing base effects continue to put a downward pressure on inflation, which is quite positive for us, and we expect this trend to persist at least in Q1 of next year, moving into next year. We've seen interest rates kind of stabilize in terms of the benchmark interest rates. At the MPC meetings, we saw, I think a lot of expectation was going, at least media was going towards them hiking rates to curb inflation. But when we started seeing the base effects kick in, the MPC maintained status quo on that front as well. In terms of debt to GDP, I think this is one of the very positive parameters for Nigeria, especially when you're looking at other SSA countries as well. Debt to GDP relatively one of the lowest in Africa and sub-Saharan Africa as well at 22% compared to the likes of Ghana, which are slightly elevated at 77%, and in Egypt as well at 90%. In terms of outstanding Eurobond issuance, we're still quite 14 billion, and obviously looking at our external reserve at 41 billion, we're still quite sustainable there in terms of meeting any Eurobond or unforeseen Eurobond payments in near to midterm. I think the only concern that foreign investors are pretty much looking at for Nigeria is our debt service revenue, which has been a major concern. Last year, roughly above 70%, and that has created a lot of concerns in terms of how sustainable Nigeria's debt has become over time as well. I think one key thing that foreign investors will be looking at is how Nigeria play out with subsidy. There's a lot of conversations around subsidy in recent times, and if Nigeria is definitely going to, given the fact that we have signed the PIB into law, if we're going to see that removal of subsidy, if that happens, definitely see a sustainable movement in Nigerian Eurobond yield. So our forecast or expectation or our topic for the Nigerian Eurobond would be the Nigerian 2032s, particularly given how it has moved and also given current levels as well. We should expect some slight increase there, but nevertheless, from given the increase in tapering and also the hike in US interest rate, like Afolabi has also mentioned as well, it definitely creates more positive entry points for Nigeria. Also, Nigeria is definitely a good bias, especially when you're comparing it with other SSA Eurobonds there as well. So just moving on to the next country that we cover, which is Ghana. A lot of questions has been on Ghana in recent weeks around debt sustainability. Just put that in context, over a brief period of August to now, we've seen roughly 300 basis points upward movement in Ghana yields. And this is largely driven by one, definitely the global fiscal sentiment that we're seeing on the back of concerns or pretty much concerns around normalization in interest rates, and also Ghana's debt sustainability as well. Like I said, debt to GDP roughly at 77%, which is quite concerning. Revenue as well, still quite underperforming from pre-COVID levels as well, which has further created concerns for Ghana. In terms of inflation, we've seen inflation pretty much increase for the fifth consecutive month to 11%, and that has been driven by food inflation over the past couple of months. For interest rates, at the last MPC meeting that was held this month as well, they raised interest rates by 100 basis points in order to address or curb these inflationary pressures. But nevertheless, this had pretty much a knee-jerk reaction in the Eurobond markets, as a lot of foreign investors obviously priced this higher interest rates into higher funding costs for Ghana debt as well. But one positive upside to look at for Ghana for next year is the fact that, like my colleague Budak already mentioned, that Ghana is a regular visitor in the Eurobond markets, and over the past 3 to 4 years has tapped roughly 3 to 4 billion in the Eurobond market. But the premiums came out to say that next year they'll just be looking to tap 1 billion in the Eurobond market next year, which would definitely kind of a positive for Ghana, given the limited supply we're expecting in Ghana next year. But nevertheless, the key thing will be how the budget perform next year in terms of revenue performance. We're looking at the GDP growth at 3.9%, right? It's looking quite positive. But when you compare it with where it was Q3 2020, roughly down by 5% as well. Do not think that we are Ghana is still not at that recovery pace that it should be. Definitely prior to COVID, the COVID pandemic, Ghana pretty much doing decent in terms of 5 to 6% growth rate, but they're still kind of struggling to recover from the COVID period as well. But nevertheless, when we start seeing a recovery, that would like we expect next year, we expect to see that also translates into Ghana Eurobond. You've seen how fast and sharp it has moved over the past couple of months as well. So Ghana 2032 is definitely a topic for us moving into next year, especially given the liquidity on that bond and also given the attractive yield on that bond as well. So the next country specific we'll be looking at is Egypt. Egypt is definitely one of the good stories in terms of fundamentals in Africa. If you look at when we had the energy commodity price crisis in 2016, Egypt was one of the countries that made tough decisions in terms of sectoral reforms, in terms of currency reforms, in terms of infrastructural reforms, and they are reaping the benefit of this. This is one of the countries that have been held steady during the COVID period, and as the latest data in terms of their GDP, we saw GDP print at 7.1%, right, which is definitely quite quite attractive on the Egypt front as well. Inflation still below the benchmark interest rates. Egypt is one of the countries that's still yielding a positive rate of return when you look at comparing the interest rate with what inflation is currently doing. I think the only concern for Egypt is the debt to GDP, roughly close to 90%. To tell you that all this infrastructural spending, all the sectoral reforms, all came at a cost for Egypt. And nevertheless, we expect Egypt to pretty much continue on the fiscal consolidation path on that front as well, as we expect them to continue to reduce and improve in terms of earnings and also pretty much sustainable debts as well. Egypt is going to be relisted on the JP Morgan Emerging Market Bond Index, which will definitely yield to a lower yield in terms of their borrowings there as well. It's definitely a positive upside for Egypt moving into next year. Definitely looking at what Egypt 2032s are also doing as well, breaching the highs in 2018 as well. So we expect that to definitely be a topic for us this year in terms of liquidity, in terms of the fundamentals there as well, quite solid for Egypt moving into next year. So the last country under our coverage is going to be Angola. I think looking at all the SSA performance for this year, Angola has been the one that has held the storm, and that's because they didn't really visit the Eurobond market this year. When we saw Nigeria coming to issue 4 billion, when we saw Ghana coming to issue roughly 3 billion, when we saw Egypt, same amount as well, 3 billion. Angola, we're pretty much focused on the fiscal constraints and debt sustainability as well. We saw significant improvements in Angola's debt to GDP. Last year, it was quite worrisome. Debt to GDP was roughly 128%, but we saw that improvement there, largely on the back of a slight improvement in the non-oil sector and also the improvement in crude oil prices as well. Currently, Angola's debt to GDP is at 84.8%, definitely quite an improvement for Angola. But for Angola, in terms of our topic, which is Angola 2025, the entry point might take a while, right? Given the parameters that there's going to be an election in Angola next year, and that will definitely cause a downward pressure or a negative pressure on the yields moving into next year. But after that election, which is going to be held in August next year, we expect some sustained buying interest in Angola as well. And they also made mention at their budget presentation that they'll be looking to issue an Eurobond of roughly 3 billion, and in order to meet their external debt financing for next year. The external debt financing for Angola is roughly at 5 billion. So that Eurobond issuance is to ease that external finance for them for next year. But nevertheless, given the continuous action that we're seeing in Angola to reduce their debt, constraints, their fiscal concerns there as well. We expect to see some more major policy changes in Angola next year as well, which would definitely bode well for their Eurobond deals next year. So this next slide is pretty much just giving us a scenario play of our cheese in the Eurobond market. Our top picks, the Nigeria 2032s, Ghana 2032s, Angola 2029s, and Egypt 2032s there as well. Just giving us, if we invest at this our top pick levels next year, and also when we will see that get to that level this year as well, see some quite significant uptick. Like I said, after every strong uptick in yields, we'll always see a correction in the SSA space as well. We expect that to happen towards the end of next year. So yes, this is our topic, and with that, we're concluding with this presentation and handing over to Tinu for our Q&A session. Thank you.
Okay, thank you very much, Emmanuel. Thank you, Udwak, and also Afolabi. That was a great delivery. So much insight. Before we go to the Q&A, where we get to ask the panelists different questions, you can also participate in this as a presenter, right? So we have some questions already. We have almost 8 questions at this point. We encourage people, the attendees, to please make do with the Q&A dashboard. Send in your questions while we address the ones that are already in. So thank you very much once again. But before I go into the Q&A dashboard, I just want to quickly ask a question, and I think this question is meant for Afolabi. Afolabi?
Yes.
Okay, all right, so thank you very much. You did a presentation around the US monetary policy posture and also historical trends. And in there, you made mention of the COVID-19. So I could recall that in late 2019 to 2020, we experienced COVID-19 and the impact was felt in the financial markets, right? Recently, the news of Omicron also got to the media, just as COVID-19 did back then. So what is the expectation? What is your expectation? Do we expect some impacts in the markets in short to mid-term, given the fact that we are not even sure if the produced vaccine would be able to immune anyone against the unusual effect of this current, what's it called, of this Omicron? So I just want you to quickly shed some light on that. So what do you think?
All right, thanks, Tinu. I think the first thing I would want to note is the market is, quite proactive. So when it comes to say responding or reacting to that virus, I would say we've gotten that first knee-jerk reaction. So if you look across SSA papers, you would see that since the news of that Omicron hit, there has been a bit of a sell-off. And if you look at the commodities market, like I pointed to earlier, there has been that drastic reaction in terms of that sharp drop in price. But say looking into the horizon and filtering out the noise that usually kicks in whenever a news of this magnitude actually hits, the determining factor, there's a bit of an uncertainty there. The determining factor would actually be to what extent would Omicron pose as a threat when it comes to, say, maybe improving or worsening the state of or the rate of hospitalization and illness? How evasive would it prove to be against available vaccines and therapeuticals? So I think that would be what would really shape, that's what would shape the performance of the market going forward, at least from that virus market relationship perspective. And recently, we have some information on that, but it's still quite anecdotal that the impact of the virus is, still a bit mild, but then nothing substantial has been put forward. So the market is still a bit in that wait and see approach. So I think the determining factor would be the severity of the strain, and we would see the market respond accordingly should it prove to be a significant threat.
Okay, all right. Thank you very much, Afolabi. Okay, so now I go to the dashboard. We already have some questions. Okay, so the first question here is, do you think, okay, this sounds like my question anyway, but in another form, do you think the outbreak of the new COVID variant will influence the Fed's decision to taper soon? I would like Kenneth Bright to attempt this. Kenneth.
Okay, thank you very much, Tinu, and to the other members of the team for the excellent presentation so far. So to your question, I would say first is similar to what Afolabi answered, but whether it will influence the Fed in his decision, that's too soon to judge. And the reason is, like Afolabi said, a lot of tests are still ongoing, and the impact or the severity of the variant, it has not been really determined. From Powell's speech in the Congress yesterday, I think the major concern is inflation. And inflation, the view before now was that inflation is a little bit transitory, but that view seems to be changing, and inflation seems to be a major concern. And that is impacting the Fed's decision to taper very sooner. So I don't think the impact of Omicron variant is a concern for now for the Fed. Thank you. So Tina, we can't hear you. Can you just put on your mic?
All right, my apologies. I left my mic muted. All right, so thank you very much, Kenneth. I think that addresses that question. So right now we have another question from Inekaibi. How do you think the coordinated SPR crude oil releases by the US and other nations coupled with OPEC plus gradual output increase would affect prices in the new year? So Kenneth, I would like you to address that too.
Okay, like we know, for commodities, like for any commodity, prices is determined by demand and supply. So for crude oil, supply is usually influenced by OPEC, and in some cases OPEC plus, while demand in recent times has been influenced by the pace of the global recovery, which we have seen. So the SPR, which is a strategic petroleum reserve release by the US, the US signed a $50 million barrels per day release, which the first phase was kick-started on the 24th of November. So what we have seen for this release is, so far, it's supposed to be a coordinated coordination with different countries like India and China. So what we have seen so far, that has not really impacted prices. The first drop we saw in prices to the current levels of $70 per barrel was more as a result of the Omicron virus. And the reason for this is that the releases we are seeing so far will not really greatly impact the supply levels. And it's still largely uncertain how much releases we'll see going forward. So I don't think that the SPR will have a major influence on prices going further. And that's why our view is that prices will inch up slightly to around the $74 per barrel levels. Another major elephant in the room, which we always have to talk about, is COVID. COVID is a major influencer of demand. So if, like what we saw in the first half of 2020, the global demand slowed because a lot of economies were in lockdown. So if and what we have seen in recent times is that the pace of global recovery has inched up, and a lot of more demand has also followed that pace. So if the Omicron variant becomes a major concern, we could see some economies shut down, which will impact world demand. So the caveat on the outlook for oil prices is still also dependent on COVID. But in terms of the SPR, I don't think it will have a major influence on prices. Thank you.
Okay, thank you very much, Kenneth. You don't think that would have major influence on prices? Okay, so a question here, I would like Tosin to address this. From a volatility perspective, is there an instrument that can be created to manage the downside for clients? So I believe this particular attendee is speaking to the Eurobond market at this particular point in time. So is there an instrument that can be created to manage the downside for clients?
Thank you, Tinu, for the presentation so far. Well done to Afolabi, Emmanuel, and Udwak for a nice presentation. Well done to Kenneth as well for taking those questions, very well. I think the first thing we need to understand is the SSA Eurobond space, just like any other market, will certainly and continue to be plagued with a lot of volatility. And what that means is that for you to enjoy that space, you need to have the support or the service of professionals that are very versed in this area and professionals that are experienced as well. They've seen the ups and downs. They are also very close to the market. They pay a lot of attention to news, whether negative news or positive news coming out of the US market, coming out of Europe, and coming out of the Asian market. I mean, we could see what happened in 2020, and of course, from the beginning of this year, what happened in China, the Evergrande, episode, how it impact the Eurobond space. So for us at Commercial Partners, not just Commercial Partners Asset Management, but Commercial Partners Group, we are professionals that would help you with, coming up with solutions that would, in a way, address the volatility and minimize your losses. Please let us be aware that if you must enjoy the reward of any investment, you must also be prepared for some minimal amount of losses. So we are not magicians, but we try as much as possible, leveraging on our skill sets and our experience to help our customers and our clients to manage the losses. So to the question, I think for us, we have two products. We sat down and we looked at what has happened this year. And we said to ourselves that how can we mitigate against losses for our clients going forward? So the first thing we want to do is, which we will introduce, or which we have already introduced, is to have an active portfolio management strategies. A lot of our clients last year and this year, they bought and they devised a buy and hold strategy. Buy and hold strategy means that you are buying a 10-year instrument and you get your coupon, but you are not aware of the price volatility, because the price volatility could impact your investment and come anytime you want to terminate your investment or sell in a ready-made market, because this market is actually very liquid. You will observe that you are unable to get your principal back. That is because you've not paid a lot of attention to the price volatility. The price volatility could be as a result of so many things we've mentioned here. The COVID variants, the crude oil prices, because most of these countries, particularly the likes of Nigeria, Egypt, and Angola, they are driven the impact on their papers significantly, whether positively or negatively. So you could be in the comfort of your home or be in the office and not paying attention to the direction of these prices or the crude oil prices or even the commodity prices. And before you know it, your investments are impacted. So through the active portfolio management, you are ceding the responsibility to us to help you to manage your portfolio actively. So we will be having a dialogue from time to time. We will select periodically when you want us to have conversation. We thought that it was important for us to introduce this because a lot of our clients would rather buy and hold. They are non-discretionary clients. The ones that are discretionary clients are basically ceding that responsibility to us. That's Tosin, you and your team, Tosin, Namdi, Steve, please, can you guys help us to manage this portfolio? So we need to have that kind of agreement, okay? That's number one. Number two, if you don't want to take any risk at all, but you are okay with a decent return that will come to you, we have another product called commercial dollar investment. The commercial dollar investment is an investment within a period of 6 months to 1 year. And the return you get from mutual funds or from any other. And with that, what you're saying to us is that we have a basket of the SSA Europa where we trade actively. The return from that basket is what we give to you. So you know that within a period, a time horizon of 12 months, you have an idea how much would come to you. That amount that will come to you is something you can plan and anticipate that will come. Those are the two solutions that we think would help you to mitigate your volatility in your investment. So over to you, please.
All right. Thank you very much, Tosi. Thank you very much. All right. So I'm just going to move to the next question, and that is, what do you think are the biggest threats to the Nigerian, Egyptian, Ghanaian, and also Angolan economies in 2022? So Emmanuel, would you like to take this? What do you think are the biggest threats to the Nigerian, Egyptian, Ghanaian, and also Angolan economies in 2022? So you can also relate this to the sovereigns, those specific sovereigns, Eurobond space.
Yes, so I think for Nigeria, we're still facing quite a lot of headwinds, micro headwinds, microeconomic headwinds when you're looking at the insecurity that we have on food, on the food inflation side as well. That might, if that intensifying next year, might obviously dampen this downward decline we're seeing in food inflation. FDIs also remain a constraint for us. Over the past 5 years, we have pretty much underperformed in the FDIs, and we know that for B2C sustainable economic growth, we need to see more investment, foreign investment into the FDI space as well. Also very, very important will be the currency trend for next year. We can see now that the CBN has pretty much reloaded its arsenal for currency projections or currency volatility next year. External reserves is roughly at $41 billion. We're also seeing the parallel market rate as well appreciate slightly. This is largely due to the fact that the CBN has been intentional in parallel market activities this year. So those are the very key parameters. FX, how CBN intend to handle FX next year. Definitely picking money out from the external reserve to sustain your currency might not be sustainable in the long term. So it's interesting to see the FX policy and how market react to those FX policies as well. Food insecurity, also a major concern in terms of food inflation, and FDI as well in terms of sustainable economic growth. The budget performance will definitely still be a play. We're also looking at capital expenditure, which is definitely meant to grow your economy. The government has always underperformed. Performance there has just been roughly 60 to 65% in terms of our budget, which is definitely not good enough if we hope to pretty much move into a well-sustainable GDP growth for 2022. For Angola, I think I mentioned is that the political rigs election next year will be a major determinant or a major threat for their economic performance and also their Eurobond performance for next year. I think we're already seeing the insecurity in Ethiopia. Obviously African countries and election hasn't really been on a good plane yet in recent times. So that's definitely a very key parameter to look out for Angola next year. For Egypt, Egypt is very, very, very sensitive to external development. Current offshore holdings in Egypt's local market is roughly at 24%. So I'll tell you how reactive the Egypt market can be when we see a strong risk of sentiment in the global space as well. So that's definitely one of the very key things to look how this COVID, this new strain, Omicron, pretty much develops in recent, in near to midterm as well. That's definitely one key variable to look out for, because that might also dampen Egypt's activity in terms of their financial market. In terms of the revenue, tourism has become a major contributor for Egypt in recent times as well. Revenue from tourism, we saw that decline in 2020 on the back of the whole COVID-19 lockdown. We're seeing that pick up. Expectation or estimate is that tourism should do roughly $11 billion this year. So if we continue to see renewed COVID restriction, we see renewed locked down a travel ban as well. That might dampen the outlook for Egypt next year. For Ghana, like I said, debt sustainability is the major topic for Ghana moving into next year. And they also remain very sensitive to offshore exposure, given the exposure that offshore has their local markets. For Nigeria, we're pretty much too cool at that point, given how reduced we have seen participation of offshore in the fixed income market, seen how reduced we've seen offshore participation in the equities market as well. So in terms of sensitivity to external factors, we are still pretty much on the good side. But for the likes of Egypt and Ghana, they remain largely very sensitive to external development as well, and definitely need to see how the whole COVID-19 plays out next year as well. Egypt's vaccination rate, Ghana vaccination rate is still quite low, roughly 3%, right? So that's not enough to create immunity in that country there as well. So those are the key factors that might dampen Egypt and Ghana revenue factors. And for Nigeria, definitely food inflation is a key thing to watch out for next year, and also pre-election spending for Nigeria. I hope that answers your question, Tini.
Oh yes, so thank you very much. Emmanuel, so from what you just said now, it sounds like there is something that seems like good news for Nigeria within this context when we compare it to Ghana and and Egypt. So thanks. It is pretty unusual that we get to hear things like this, especially when it comes to be comparing Nigeria. All right, so thank you very much once again. So speaking to election, you mentioned election, and this will take me to this next question. Given that 2022 is preceding year to the elections in Nigeria, what is your view on the impact, if any, what impact would this have on investor appetite for Nigeria Eurobonds? Let me come again. Given that 2022 is preceding year to the elections in Nigeria, what is your view on the impact, if any? What impact would this have on investor appetite for Nigerian Eurobonds? Tosin, would you like to address this?
Thank you once again, Tino. I think for me, what I think would happen is you will certainly see some interest in Nigerian Eurobond, not just because of the eve of election, but I think because we have decent prices now, so we're getting to the bottom or the deep of the yield curve, and people naturally, when they see good decent return on their dollars, they tend to move to it. A lot of people, I think a decent amount of people also in 2022 will begin to look at how to diversify their portfolio away from Naira. Naira is certainly at a very relatively stable right now, but we all understand that if you look at what has happened in the last 5 years, okay, between every 5 to 10 years, what you see is Naira actually doubling, or in terms of depreciation, I mean, dollar against Naira actually doubling, or at the very worst, you see a level of 70 to 80% increase in your dollar holding as a result of the depreciation of the Naira. If you know that, and you look at the external reserves that we have, you will understand that the external reserve that we have cannot in any way take us to the next 5 years. So what that means is that there's going to be a lot of pressure clearly on Naira. Obviously, this pressure would arise from the fact that we are still a consuming nation. We are not a producing nation. I actually think that what we have with the $41 billion the external reserve, it's not enough to support the Naira. So what would happen is after the phase of election, you will see some significant weakness in the Naira. Obviously, you see a lot of activities. And by that, I mean, you see demand picking up. Activities will naturally pick up because I expect that the nuances around COVID would have toned down significantly. And when that happens, you expect activity to pick up globally. Activities picking up globally means activities picking up in Nigeria as well. Your GDP would move up. Right now, you have a GDP at 4% year on year. you would expect that to continue to move up as well. When you see activities moving up, there will be certain pressure on the Naira, unless, of course, the monetary body decides that, oh, let us play a bit with our monetary tool to keep the Naira stable. So for me, I think our house views are that you need to begin to look at how to diversify your portfolio right now when Naira is still relatively stable. If you're able to do that, even if Naira gets to 600 or whatever it is, above 600, which a lot of quarters, people in different quarters have, posited that might happen next year or year after, you would have, in a way, safeguarded yourself with the assets or the investment you have from those depreciation that might happen in the next 1 or 2 years. So when you have the yield on Nigerian Eurobond particularly, and you are comfortable because you understand the dynamics of the Nigerian market, even if you don't understand in Angola or the Egyptian market, but you understand in the Nigerian market, I think that you feel comfortable if you see a decent yield of 9 or 10% around the corridors of 9 or 10% on Nigerian dollar paper. So for me, I think next year we'll see a lot of people that will come to the market to pick, the dips of where those calls are right now. And once again, I think that for you to do that, it's important that you get some experts or professionals to help you in picking up those papers and advise you on how to manage your investment going forward.
All right, Tosin, thank you very much. Before you go, I would like you to attend to this question. What do you think will be impact of the renewed climate consciousness on emerging and frontier markets? Okay, let me come again. What do you think will be impact of the renewed climate consciousness on emerging and frontier markets capital raising plans? Okay, that says it. Did you get that?
Yeah, I heard you loud and clear. I think the impact is going to be positive. Yes, I heard you. I think for me, the impact is going to be a positive one. Why? Because the world leaders are actually looking into that space. I mean, when President Biden resumed office, one of his speeches was the fact that they will roll out a plan, that would, move them away from move them to green energy, and the plan has an estimated, budget of around $400 billion. And I think earlier this year as well, that it convened a meeting of about 40 world leaders talking about renewables and how to move the whole world, which is going to be a journey of 1,000 miles. But they feel that it's important that they begin to shape the minds of other countries into moving into climate change and renewables. So if you're looking into that space to raise capital, just like in the local space, I mean, let's take Nigeria for instance. You have some fund managers, some pension funds as well, some asset managers that are big on sukuk bond. What that means is that they have within their policies to go after climate-driven, capital raising initiative. So in the same vein as well, globally, you have countries that are driven by the goals of SDGs, and for them, it's important that they look at capital initiative or capital raising initiative that are likely driven for climate change or renewable energy. So if you're coming into that market and you want to raise funds in the international market, I think it depends on how you're able to structure that particular capital raise. If your structure and the underlying projects are likely for green energy or green finance, you will see considerable interest, irrespective of the level of Eurobond that have been coming to the market, because some of the hedge funds, portfolio managers, asset managers out there are actually looking for SDG goals driven projects. So you must be careful how you structure it. If you're structuring it around those projects, you will see some significant interest in it. So I'm very positive about it. I believe that not only globally, even in the local market, that we would see some interested investors showing interest in renewable or climate change-driven capital raise.
All right, thank you very much, Tosi. The next question goes to Kenneth. Kenneth, do you think the Omicron strain will affect Nigerian exchange rates? So this is we're speaking to the exchange rates, which is actually very critical to this conversation, especially in the financial market right here in Nigeria. So what do you think? Would this Omicron strain, will it affect Nigerian exchange rates?
Okay, for now, we have said the potency of the Omicron virus variant to cause supply chain disruptions and maybe impact crude oil prices is not very clear currently, but I don't see the strain having in the short term. What could happen is we could see more or less a disruption in. So like in the short term, what we could see if the strain develops further, what we could have is that we could have disruptions in global supply. So we will have further lockdown, like we alluded to. Part of global demand is impacted by economic recovery. If the potency of the strain increases, what will happen is that we could see shocks to crude oil prices, we will see shocks to government revenue, and that could impact on exchange rate for Nigeria in terms of reserves dwindling. And when reserves dwindle, that's usually what causes Nigeria to actually adjust its exchange rate. But I don't at the moment see that happening. So it's a really, really very far call to call, very far in terms of making an assessment, very, very difficult to call that now. But that's only the likely impact it will have. If it could impact our revenue going forward, impact reserves. So we have about 41 billion in reserves currently, and that will not move price. We don't see exchange rate moving currently. Further down the line, if the variant becomes stronger, what we will see is it could impact shutdowns, prices, and that's what will cause any worry to exchange rates. Thank you.
All right, Kenneth, thank you. Tosin, do you have something to say with respect to this? I'd like to hear your perspective.
Hi, Tino. Sorry, could you say that again?
Okay, so I just mentioned that I would like to hear your perspective with respect to this question. Kenneth just shared some insights from his own perspective anyway. So I have a question here. It says, do you think the Omicron strain will affect Nigerian exchange rates? So given the fact that exchange rate conversation is very critical to us right here in this part of the world, so do you think that this recent strain will affect Nigerian exchange rates?
I mean, I think that the impact of Omicron is limited to our exchange rate. If you read materials and listen to announcements being made in recent times about how less effective or how less pervasive that the particular variant has been, that will give us a sense of the comforts that we should expect, that yes, the world leaders and the medical personnel would keep this under check. I think that I don't see it affecting our exchange rate significantly. I don't see any significant impact on our exchange rate with regards to Omicron. The only challenge I have, which could be on the horizon, is if it continues to move to other countries without having it being checked. And that could potentially lead to shutdowns or lockdowns in certain countries. And when we begin to see that, we observe that what happens is that the SSA countries suffer for this lockdown. We don't want a repeat of what happened in 2020 when some European countries, started locking down, and in America as well, you have a lockdown. America said that they are not going to lock down, that they will continue to monitor the situation, and I expect the same thing was said by the UK government as well. So to the extent that these governments decide to leave their countries open to everybody without locking them down, I don't see any significant or meaningful impact on our exchange rate. I think what would impact our exchange rate, and which I think has been largely doused, would be any FDIs leaving the country or FPIs leaving the country. I'm not sure that we're capital flight leaving this country. The capital knows that you might see a significant, impact or marginal impact on our exchange rate.
Thank you very much, Tosin. We'll be rounding up soon, but we have just a few questions left. Okay, so there's a question here that says, to what extent can we really draw a parallel between the 1970s stagflation and the trend in the United States? Let me come again. To what extent can we really draw a parallel between the 1970s stagflation and the trend in the United States? Afolabi, since you took the global market, the global updates, I'd like you to address this.
All right, thanks, Tim. I think that's a very interesting question because over the last, say, couple of months, this is a parallel that many have been drawing, and for very good reasons. For one, we have the existence of a similar energy component in both periods. So we recall that back during that 1970s stagflation period, we had that strong upsurge in energy prices. And also this year, we could see that that strong uptrend in the price of crude has been one of the weighing factors on the inflationary trend in the United States. So you could actually see why one would draw that parallel. And another reason why you would want to look at those two periods similarly is also because of, I would say, that fiscal exorbitance. You recall back in the 1970s, say late 1960s to 1970s, we had the flurry of spendings from the government, one to fund the Vietnam War, and also to fund the Great Society social spending plan. So a lot of these, bears, say, a striking resemblance with what we saw in the year 2020, where a combination of both the Biden and the Trump administration deployed massive spendings and, say, COVID-related stimulus plans that would, of course, weigh on inflationary concerns. But I think where I would draw the line between those periods would have to do with the proactiveness of the monetary authorities. You think back to what happened in the 1970s, and we had a monetary climate that was a bit lax, that allowed inflation sort of run hot up until when we saw the Fed chairman, that was Paul Volcker, come into office somewhere towards the end of the 1970s, and as a consequence of what it was seeing with inflation, institute multiple rate hikes that proved quite instrumental in bulwarking that, say, uptrend in inflation and keeping it at bay over an extended period. So when you look back to the current period, I don't think the Fed would be that lax to allow inflation run that hot. Initially, we had those concerns, given the fact that we saw Powell repeatedly put out that transitory narrative that wasn't holding much water, given the fact that we could see that some of those drivers were not going away anytime soon. But from what we saw him say to the Congress, that was yesterday, it's looking like the Fed might actually be more in touch with what is happening. They might actually be looking to do away with that transitory narrative, and they might be willing to take more deliberate steps to actually tame that uptrend in inflation before it gets out of hand, like we saw in the 1970s. So I think in a nutshell, I would say the similarities are there, but the key difference is we have a more proactive monetary policy arm that would do what it takes before we see inflation, run out of hand and as a consequence, require more drastic measures to put it in check.
All right, thank you very much, Afolabi. The last question we're going to take is, what is the top pick for Nigeria in 2022? What is the top pick for Nigeria in 2022? Emmanuel Oji? Hi, Emmanuel. So from where you sit, what is the top pick for Nigeria in 2022? This is just advisory. Yes, basically, we are not holding you, but we are saying that what is the top pick from where you sit?
Yeah, so for us, definitely the Nigerian 2032s, which I alluded in the slide, definitely a decent yield on that paper currently. 49s as well, Nigeria 2049s. If you have appetite to go longer, Nigeria 2049 is also a very good pick, given the fact that it has quite an attractive coupon in terms of market liquidity. That seems to be one of the favorite maturities for Nigeria. So definitely see a stronger or an earlier reaction on the Nigerian 49s when we start to see an ease and normalization across all papers as well. So definitely those two major maturities, Nigerian 32s and Nigerian 2049s for me. Hi, Tina, you're mute.
Apologies, I actually have to quickly master this thing. Like, I expect it to be auto. All right, so thank you very much, everyone. Emmanuel, thank you very much. So that is Emmanuel's recommendation from where he sits, though, right? It is just basically advisory. So at this point, we would like to bring this to a close, but before we do that, it is very important that we appreciate everyone that has decided to prioritize these over every other activity that you have lined up for the day. At this point, I would like to call on Tosin to give us a closing remark before I then give a wrap-up to the event. All right, so Tosin, please, a closing remark from you.
Thank you very much, Sino, once again. First off, I think the team, the CP team, Commercial Partners team, you guys have done wonderfully well. I don't think that we expected anything less than your performance. Thank you as well, Tino, for moderating this event. I'd like to say thank you to all, our clients, potential clients, existing clients, and everybody that's been here, that's participated with us during this session. We thank you. We do not take it for granted. At least for us at Commercial Partners, we pride we bring to the table from time to time. So when we say that knowledge, or we are meant to be a knowledge center, we believe that our responsibility to our clients, whether it's potential clients, existing clients, and to the investing community at large, is to continue to enlighten and educate you on global events and local events, and help you now to position yourself with your investment. And that's why we're having this session. And I think that we'll continue to have this session next year, because we operate in a very, evolving, dynamic market. So we cannot say that, oh, this is the end of this session. Next year, we're just going to stand aloof and not educate and enlighten you, because events will always come up. So we will be having this session every quarter. I think the next one will be next quarter, Q1 2022. And obviously before the end of that period, I'm sure so many other events will come up, and we need to discuss that with you. I think we will be having in February the outlook for Nigeria, the outlook globally, and of course in the local market come February 2022. I think we owe you that much, and it's going to be a lot broader. We would have the rest of my partners that will be involved in these events come February 2022. Please take note again for the audience, if you're interested in the dollar-denominated market, if you're interested in the Eurobond space, I think that Commercial Partners is a place you need to call on. For us, the fact that we're going to start active portfolio management, we would have relationship managers for each portfolio that has been assigned by our clients or assigned to each relationship manager. We have that responsibility to make that portfolio perform better than just buying and holding. And if all you want is to keep your investment safe for a period of 6 months or 12 months, we can as well show you, good and decent return on that as well. I think for us, please get yourself, send your emails if you don't have any of our research materials. We daily and periodically, I think every week and monthly, we share with our clients our research materials. There's a particular one that I think that you would love, and that's the Trader's Voice. I mean, it comes with a bit of flavor. It's not so rigid and so steep. We try to to blend it. We blend it with a bit of fun and humor, make you feel like you understand where the global market or the local market is going, because we want to bring it to your level, to a layman's understanding, and you're able to relate it to your environment or to events happening at any particular point in time. So once again, I would like to thank everybody for joining us on this seminar or this webinar session. And we pray that as we move into 2021, we will certainly have financial goals. I pray that our financial goals shall be met. If you have financial goals for 2021, it's important that you sit with a professional and devise a strategy of how to achieve your financial goals. The financial goals could be as a result of school fees that you have to pay for your children abroad. It could be as a result of dollar obligations that you need to meet at every particular point in time. So it's important that with your financial goals come 2021, if they are dollar denominated or dollar related, you need to sit with a professional to get you to achieving this goal. Thank you once again, and God bless you all.
All right, thank you very much, Tosin. That was great. And thanks to everyone who joined us today. I just want to quickly read out some comments from the attendees. We have excellent delivery. Well done, CPT. Thank you for the session. Quite educating. Well done, guys. Big ups at Falabi. So I just want to say thank you also, because together with the attendees, I also want to say thank you to the CP team, right? If you're just joining us, normally would have said that you missed, but to be candid, technology has made life very easy. You haven't missed anything, reason being that you can catch up on our YouTube channel, our Commercial Partners, right? At any point in time to watch the replay. So my name is Sinophilis Odufuye, and you can always reach out to me. We'll definitely send you some details via your email, since we have your data, on how you can reach out to us and also indicate interest in any of the products or services that we render. So thank you very much once again. This is Commercial Partners, where our mission in the sub-Saharan African market is to empower minds. Thank you once again for joining us. Please have a great day.